Front-running is a common and often illegal activity in the trading world. It involves acting on inside information. Say a broker acts on market-moving information which is not yet public. Front-running is also common in the crypto and blockchain world. In the crypto world, front-running involves placing a transaction with the knowledge of pending transactions. Say a bot in Ethereum places an order with higher gas fee with the knowledge of pending transactions and makes a profit out of it. Now, front-running is becoming a major threat for the growth of synthetic asset platforms. Synthetic asset platform Synthetics faced major obstacle to their growth when front-runners started exploiting the Oracle Latencies on the platform and earning undue profit. It forced Synthetics to release a new upgrade. Another synthetic asset platform, LINA, promises to solve the front-running problem using low-latency, highly accurate oracles and creating a cross-chain compatible Delta 1 synthetic asset protocol. Delta 1 means the synthetic assets on LINA experience instantaneous and accurate price movements with the base assets. Now, LINA is the staking token on LINA platform and plays a major role on the platform. So let us learn about LINA and LINA. First, let us understand how Oracle Latencies are exploited for front-running. Let us take the example of Synthetics, which is a decentralized platform and exchange for synthetic assets on Ethereum. Synthetics lets users create synthetic assets or synths based on various assets including crypto assets and fiat currencies. Now, in June 2019, a sophisticated bot exploited an Oracle outage on the Synthetics platform. In this case, due to the Oracle outage, there was a price difference between the price of Korean won KRW and price of the respective synthetic SKRW. The bot owner's balance inflated due to the incorrect SKRW price feed, which the bot owner then converted into inflated amount of synthetic Ethereum. 37 million of synthetic Ethereum valued over $1 billion. This led to a bitter negotiation and settlement. The point is that this incident showed that synthetic assets can be target of expensive attacks. This was a dramatic incident, but a more common occurrence is bots reading the memory pool where unconfirmed transactions are stored and then beating those transactions by paying higher gas fee. So how to solve this problem? Now, founded in 2020, LINA protocol promises to solve this problem with low latency custom oracles and quicker transaction confirmation, as the synthetic assets on LINA are cross-chain compatible for all EVM supported blockchains. Blockchains that support EVM have much quicker block time confirmation than Ethereum. LINA also partnered with the Band protocol to develop low latency custom oracles. Anyways, let us now spend some time to learn about the LINA protocol. So what is LINA and what does it offer? LINA is a non-custodial, cross-chain compatible DeFi protocol with unlimited liquidity and serves in creation of synthetic assets with zero slippage. Zero slippage means that there is no price difference between the base assets and the synthetic assets. These synthetic assets on LINA are called liquids. LINA offers exposure to synthetic assets of crypto assets, commodities, indices, and various fiat currencies. The biggest benefit that LINA offers comes with settlement period, which is in seconds. This makes traders to quickly benefit from market opportunities, which is often not possible with base assets due to long settlement periods. Say a trader has exposure to some index fund and she wants to switch to Bitcoin. Now, in the case of traditional trading, she will have to wait a couple of days to make the trade due to cash settlement periods. This may lead to lost opportunities. With liquids, that is the synthetic assets created on Linear, this trade can happen in seconds. Apart from this, Linear offers cross-chain compatibility between Ethereum and other EVM-compatible chains. As EVM-compatible blockchains offer low block time and much lower fees, exchanging liquids that the Linear synthetic assets is much seamless. Now let us understand the structure of the Linear protocol. The Linear platform comprises of 4 major applications: Builder, Exchange, Swap, and Vault. Builder is a decentralized application or dApp. The application gives access to the Linear collateralized debt pool, which is the backbone of the Linear platform. Using Builder involves 2 primary crypto assets, LINA and LUSD. LINA is an ERC20 token built on the Ethereum network, and the main purpose of LINA is as collateral on the Linear protocol. LINA is openly tradable and can be procured from many crypto exchanges. LINA is used as collateral on the debt pool to build LUSD. LUSD is then used to get exposure on liquid synthetic assets. Now the debt position in the debt pool is over collateralized. That is, the value of the staked and locked LINA has to be higher than the value of the LUSD issued. This ratio is called pledge ratio. That is the ratio of value of staked and locked LINA and value of debt balance. Currently it is 500%. Now coming to exchange. The exchange application allows the LUSD holders to purchase liquid synthetic assets. The synthetic assets include digital assets, commodities, and Linear's own curated thematic digital traded indexes. Trades are instantaneous, have virtually no slippage, and come with 0.25% fee. Linear synthetic assets are EVM compatible and hence they can all be deposited by users in third-party pools such as Balancer, Uniswap, and Curve. Now coming to the swap application. This is a cross-chain swap functionality on the Linear platform. It helps traders save gas fees and allows composability of Linear tokens. The application is built on Ethereum and is integrated with Binance Smart Chain and is planned to be integrated with Polkadot. Now coming to Vault. Vault is an application where yield farmers can deposit their LUSD and other LP tokens to earn passive income. The liquidity providers can get reward in LINA tokens or BUSD, Binance USD, or LUSD tokens. Apart from this, there is Linear DAO. Linear DAO is the Linear Decentralized Autonomous Organization, which is still not active. Now the typical user journey for a trader on the Linear platform is like this. You can get LINA tokens from different exchanges and then stake the LINA tokens to get LUSD, and using LUSD you can get liquids or the synthetic assets. Now let us talk about the LINA token. As mentioned before, LINA is an ERC20 token on the Ethereum platform and is primarily used as a collateral on the Linear debt pool. The debt pool is accessed through the Builder application. The token has a max supply of 10 billion and as of 29th December 2021, LINA has a market cap of $159 million. Now LINA token holders who stake LINA get rewarded in various ways: pro rata exchange fee, inflationary reward, etc. Apart from this, LINA launched a staking reward program in December 2020 to reward LINA Builder and exchange users with LINA Token. Synthetic assets is a high potential use case of crypto and blockchain technology. Synthetic assets can help retail investors get access to various asset classes without much friction. LINA is trying to solve many problems in the synthetic asset industry: high fee, interoperability, and more importantly, front running. With this is Sam Ghosh. Thank you very much for watching. Bye-bye.